Hello guys, I'm gonna start material costing, and this is what we'll be looking at in the next series of videos we'll be doing on management accounting. And these 5 categories will be the outline on how we're gonna take care of this topic. Remember, my videos are always exam focused. With these videos, you are okay and sufficient to pass your exams. If you watch my video, you must be able to go straight to your question bank and start solving questions on any topic that I've dealt with. If I've dealt with any topic and you struggle with any question, please, I will be happy to help you. You must not struggle because of my approach to these videos. So we'll look at introduction, we'll look at the ordering process, we'll look at the inventory control, and we'll look at inventory management, and we'll end it with inventory valuation. These are the 5 summary of material costing of your syllabus, and if you cover all of these 5 areas, you are home and dry on material costing. Straight to business. Let's do a bit of introduction. What is material? Material are just your input to your production. It's one of the input. But basically the major tangible physical item you use putting into your production process to get your final product. And let's look at an example of a final product. Say you have a chair. What comes to mind? You need a material. What material do you need? You need wood. If it's a wooden chair, you need metal if it's a metallic chair. But let's say it's a wooden chair, so you need wood as your material. But ladies and gentlemen, remember, we said material is your input, which means when you have material, what do? You have to process it. After you process it, you have a product. So start from here to here and finally to this point. This is what you have as a finished goods, your product, right? And that's why in this syllabus you're expected to know 3 types of materials. The first one is your raw material, the second one is your work in progress, and the third one is your finished product, which is the finished material. Right? So invariably what we're saying is this is your unprocessed material. You've not done anything on it. For example, you have log of woods lying everywhere, unprocessed. Then sometimes you commence the production, you start making the chair, then this is in process. It is not yet a final product, and at the same time it is no more a raw product. So you might have a chair like this, the back is there, the seat is there, but only have one leg. So it's not a finished product, it's just work in progress. And the third one is your processed, which is your finished product, and that is fully processed. And that is when you see a full chair standing upright with 4 legs. That's a finished product. And just to remind you, I know we spoke about direct and indirect cost in my previous video. I want to remind you, material is a direct cost. Please take notes because it is what you directly use in the production, and you can account for it for each unit of production you made. And also, I remember I spoke to you about variable and fixed cost, because the more material you use, the more product you will get. So you're able to attribute every quantity of product you've made to a particular chunk of material that you have used to make that product, and because of that it's a variable cost. So which means the cost of material will increase with the increase in quantity of production. So it's a variable cost and it's also a direct cost. It is not an indirect and it's not fixed. Just a reminder about that. So that is introduction part of it. So gradually we're making progress on our outline. So we're done with this part, which is good. Now let's look at the second part, which is the ordering process. You need to have an understanding of how orders are being made, right? Take for instance, you work in a warehouse. The man in the warehouse looks into the warehouse. He doesn't see materials, so which means he has identified a need to buy materials. And what does he do? He raises a document called your purchase requisition. So this is a document that is telling the procurement team that, guys, please, I need you guys to help me buy another material. I need more material. So that's a purchase requisition, which is about need awareness. We need something. Once that is done, then the next thing is procurement department can now issue a purchase order. And purchase order is informing the vendor to supply an item. So we are telling a vendor to please sell to us. We need something, sell to us. We need here, we're asking you to sell to us here. And that is purchase order document. You need to understand all this document. This cycle is very important in your subsequent papers as well. When you do audit paper, you do performance management, financial management. In fact, the whole of this topic is extremely important. In fact, I have videos on AA, on FM, where material costing and all the cycles have been covered as well. But I'm taking it differently in this paper because you are relatively new in accounting, so I'm breaking it down very well for you. But please take note. Once we inform our vendor to sell to us, then they will sell to us and they will deliver. Once we receive it, when they dispatch it to us, they're going to issue a dispatch note. This is called a dispatch note. That will come with the order. And when we receive it, we will issue good receipt notes to show that we have received the item. And once we've received the item, they issue us invoice. The seller will issue us invoice, and once we receive the invoice, we pay the invoice. So this is the summary of ordering process in one very short page. You see everything, and we call it P2P, which is purchase to pay, right? From purchase to paying. Yeah, some people struggle with this, but you have it easy in a very summarized way, and that is the ordering process. Now moving to the third one. This is also done. Now let's speak on inventory control, which is the third outline. Inventory control. Remember, our inventory involves materials, whether it's raw, whether it's in process, whether it's finished goods. All of that, all put together, will make up what is called inventory. So I don't want to get confused when you see me using the word material or using the word inventory. The difference between inventory and material is not anything substantial. They are almost the same thing. It's just a general word for raw materials, for materials in progress, and as well the finished materials. The general terminology is called inventory because it's what we have. Why do we need to control inventory? In fact, some people call it inventory monitoring. The first thing you should ask yourself is why? Why do we need to do that? The reason why we have to do that is because we need to ensure that the actual, which is a physical inventory in the warehouse, is equal or the same thing as what we have recorded in our financial statement, which is our books. That's our record. We don't want a situation whereby we are saying in financial statement we have 30 million worth of goods or worth of inventory, but when we go into the warehouse, we only have 26. That is error. And that takes me to what usually causes a situation whereby this might not be equal. Why? Why might it not be equal? Because there might be error, or there might even be fraud. Someone might be stealing the inventory. So there might be fraud. So because of that, we need to ensure that we perform activities that will make this to be equal. So the question is how? Now we know why. How do we ensure that they are always equal? There are two ways of how. two good ways. The first one is called your perpetual method. Perpetual. Your perpetual method, and the second one is your periodic stock count. Those are two approaches to ensuring that we have equal actual and financial record. For perpetual, what does it mean? What we are saying here is that we are constantly updating our record. Here we are constantly updating inventory record. Every time we sell or buy. So, when we sell, inventory leaves our warehouse, and when we buy, inventory comes to our warehouse. So every time any of this is happening, we are constantly updating immediately. And there are two ways of also doing this. Either we use a computer system to do it, and that is called automatic perpetual method or automated. And the other one is manual, which means we have human going to update an Excel document or a paper document manually. But if it is by system, as we are issuing the inventory, we are issuing in the system, and the system is updating the record automatically. But the stock count is usually periodic. And how do we do this? What we are saying is we go into the warehouse either monthly. You can go in there, decide to do it monthly, or we do it quarterly, or we do it annually, end of the year. And what are we doing? We will count every single inventory that we have. We count it, and whatever we have, as our count result is the only thing we're going to record on the financial statement. So once we do that, the physical record will always be equals to financial record. And if there's any discrepancy, then this is your final. You must adjust to this final. That is how to control or monitor inventory. And that is the third part of our outline. Done. Let's talk about the fourth part of the outline, which is talking about inventory management. So let's look at inventory management. Inventory management. Now it's getting a bit more interesting. Please pay attention. Like I said, I'll start from again. Why do we need to manage inventory? We've spoken about monitoring inventory. Why we need to monitor. Now, why do we need to manage inventory? There are two things we're talking about. We want to manage the cost associated. The fact that we have inventory, there are costs associated with having inventory. Likewise, we need to manage the quantity. So this cost, we want to minimize it as much as possible. So, and this quantity, we want to make sure that we have optimal level. That is, we don't want to have too much, so not too much and not too little. That's what we're saying. So we want to have optimal. This is what we want to have. Optimal means the most appropriate level. And for the cost associated with inventory, we want to minimize it as much as possible. That is why. Now, we're going to take each of these and see how do we go about them. How do we start to minimize the cost? How do we try to optimize the quantity? The first thing we'll deal with, let's deal with the cost. Before we talk about how, we need to know what exactly is this cost that we're talking about. So what are these costs associated with inventory that we're talking about? There are 4 of them, which you must know. The first one is your purchase cost, which is usually the price of your materials, of your inventory. The second one is your holding cost. An example of this is your rent of the warehouse. Remember, when you have inventory, you have to keep them somewhere. You need to hold them somewhere. You need to keep them in a place where they are safe and secured. That building where you are keeping it is not free. Even if it is your property, you must have bought it and there's a depreciation on it. If it is not your property, you must have rented it and you have to pay lease on it. So there's a cost for holding every inventory. And the more inventory you have, the bigger space you will need, then the more holding cost you will be incurring. So that is about holding cost. The third one is your ordering cost. Your ordering cost is the cost associated with placing an order. Remember when we spoke about the cycle, we said from PR to PO to all of this, to processing the invoice, to paying the invoice. This is ordering process. This comes at a cost because there are people who are involved. There are documents that needs to be raised, and there are people who needs to be paid for doing the work they are doing. So this kind of cost is usually termed as administrative cost. But you will always be given the amount of your ordering cost in your exams. The fourth one, which is the final one, is the stock out cost. Stock out cost is very, very subtle. It's not as easily quantifiable as other costs above. However, it's a very, very risky situation that no company should find themselves. An example is you can lose revenue because you don't have inventory. Because stock out cost is just simply saying that we don't have inventory to sell when we have orders from customers requiring or requesting us to sell things to them. A has come to us, Mr. G, please sell me 2 bottles of wine. I look at my inventory, I don't have. My stock is out. I will lose that revenue. And I might also lose goodwill. So all of that is stock out cost. So this one is not quantifiable. You need to just understand it, but it's not going to be important in our calculation. But you need to understand it. So in our calculation going forward, we'll focus on the first 3 items. So take note. Now we know this cost that we need to minimize. Remember, we want to minimize this cost. We want to bring it down as much as possible. Now the question is, how do we bring it down? How? What do we need to do? There are 3 approaches that any company can adopt. And not to say that one approach is better than the other, but a company will need to check their circumstance, their situation, and assess the 3 methods to decide which one will be most appropriate for them. The first method is called the economic order quantity model, which is called EOQ. The second method is the bulk purchase discount approach. And the third one is the just-in-time approach, JIT, BPD. So these are the 3 methods that you can use to reduce or optimize the cost associated with inventory. For just-in-time, we will not be doing any calculation on this one. So you just need to understand it. What is just-in-time? Just-in-time is saying that for us as a company, if we're going to use just-in-time model, it means we are never going to keep inventory in our warehouse. We don't even need a warehouse because we will not buy inventory until we find a customer who is ready to pick up the inventory. So no excess raw materials, no excess work in progress, no excess final product. At every stage in time, what we need is what we buy, what we need is what we process. And need will be driven by the customer's orders. So in that case, what you realize is we'll be ordering so many times. So ordering cost will be very high. Purchase price might be high as well because we'll be buying immediately as the customers need them. And we'll be buying desperately. We might not be able to negotiate because we don't have enough time to talk to so many suppliers. But what happens to our holding cost? It will come down because we are not holding any inventory. So you can see how that will impact on all the three costs. You need to understand that is the way you can be tested on this one, the theoretical approach. Right? So let me call this one HC, let me call this one P, and this one OC. So that going forward, when I'm using those alphabets, you can relate with them. OC, HC, and purchase price. Yeah. Very good. Now, these are the two where we'll spend some good time and we'll solve questions as well on this. Right. But let me just quickly explain EOQ, the first one. Like I said, EOQ, just like bulk purchase discount, aims at the same thing: to optimize cost, to minimize cost. But they do it in different ways. For EOQ, what EOQ tries to do is to focus on ordering cost and holding cost. And what does it do? It tries to minimize ordering cost and holding cost. In fact, EOQ, remember, is a quantity. So it's not like a rocket science. It's just a quantity. And what type of quantity? It's a quantity of orders that you need to place every time you want to order. So it's telling you that if you're going to use EOQ model, you need to calculate your EOQ. And once you know your EOQ, which is a quantity, right? Say you calculate your EOQ and it's 500 units. What this approach is saying that every time you need to order, you must order 500 units. So your order quantity is equals to 500. That is what it's saying. That anytime you need to place an order, you must place 500 units. Not less, not more. And that is why at EOQ, because it tries to minimize your OC and HC, your annual, which is your total ordering cost, annual ordering cost is always equals to annual holding cost. They are always equal if you are using EOQ model. So if in exams you are given annual ordering cost and they tell you that the company is using EOQ, the question might say calculate the annual holding cost or calculate holding cost per unit. Please note that your annual holding cost and your annual ordering cost will be equal if you are using EOQ, and you don't need to do another calculation for annual holding cost. You just use the figure, and if it's per unit, then you can divide by the total number of units, average inventory, which we'll get into as we move on. So what this means that you need to know how to calculate annual ordering cost and annual holding cost, and I will teach you how to do that. But before I go into that, please note that, as you will expect, the number of orders will be directly proportional to your ordering cost. So which means the higher the number of orders you make in a year, the higher the annual ordering cost that you will incur. Yeah? Remember? However, it's the size that matters for holding cost. So the size of orders is directly proportional to your annual holding cost. Because you can imagine if you are ordering big size, then you expect a bigger space to be needed, and that means you'll be paying higher rent. And what does that mean? Your holding cost will go up.